In the previous sessions, we talked about economic, industry and company analysis. We started those sessions on EIC analysis, popularly known as, and in the first two sessions we talked about economic analysis, then we followed up with industry analysis. Now, the third part of this top to bottom approach is known as company analysis. In this company analysis, we are going to cover the following things. We will talk about why this company analysis is required, what is the importance of this. We will talk about company analysis and stock valuation. Is the company analysis and stock valuation the same or they are different? Then we will talk about the broad methodology of company analysis, where we talk about the strategy analysis and then analysis of financial reports. In strategy analysis, we are going to be discussing about what is strategy, what are different types of strategy, and depending on the organization, we will talk about the Porter's 5 forces model. We will also discuss about SWOT analysis, known as strength, weakness, opportunity and threat analysis for a particular company. We will also discuss about another tool, popular tool, that is called PEST or PEST analysis, where we talk about political, economic, social and technological changes that can affect the company's performance, that we will discuss. And subsequently, we will talk about different authors who have talked about what should be the things that the people or the investor analysts should look at while choosing a company, and what type of strategy this company should be looked at. Those things we will discuss, and subsequently we will follow it up with financial report analysis and what are the things that we are going to look in financial reports. So, basically in the first part of this company analysis, we will talk about strategy analysis, and second part we will also talk about strategy analysis as well as financial statement analysis or financial reporting analysis. What are the things that we are going to look at from the financial reports. Now, moving on, we talk about the why we should go for the company analysis. Till now we have looked at the economy, and we have also looked at stock market of different countries. We will look at, then in that, after looking at that, one decides about the particular industry to at least to the invest in stock market, allocate a particular amount of its portfolio in the stock market. Then having discussed that, okay, this particular country or economy to invest, then we look at which particular industry is better providing better opportunity. We discuss about the industry and choose the industry where to invest. Having decided with the industry, then we discuss about, we find out where should we put the money in a particular company, because industry can consist of as many companies, and one has to look at the best company in that gamut of set of industry assets, and then find out which companies we invested and which companies are good companies. And it is not necessary that if there is a good company, that means the stock also should be good. So, we have to look at that also, and in that, once you look at the industry, we look at which is the best companies to find out, and having found the best companies and whether the prices of those companies in terms of stock are overpriced or underpriced. If they are overpriced, definitely we are not going to invest, or rather if you have invested, we will exit from that, or if it is underpriced, there is an opportunity that we are going to invest in that. So, next way to move on, we talk about the company analysis versus stock analysis, stock company valuation versus stock valuation. In that, certain things that we must note here is that good companies are not necessarily good investments. Companies may offer good opportunities, but the stock in that particular company may not be offering good opportunity, in a way that the stock might be already overpriced, and there may not be opportunity for one to invest and get some return as such. Because the company has been good, the stock may be have a good in demand, and that is why the price of the stock may be very high. So, whatever value that we find out, called intrinsic value, whatever we find out by applying particular methodology, we may end up finding that the intrinsic value is actually less than the market price as such. In that case, though the company is good, the company stock may not be attractive. So, one has to look at that good company need not reflect that the stock of the company is also good as such. Then another point that we talk about, as we discussed, intrinsic value of stock has to be compared to the market value. So, if only when the intrinsic value of the particular stock is more than the market value of the stock, then it is a question of investing, otherwise it should not be investing as such. So, as we discussed, intrinsic value of the stock should be an attractive proposition, not necessarily the company itself is an attractive proposition. Another point in this particular context is that the stock of a great company may be overpriced, so it is not an attractive proposition. And the last thing that we discuss in this is that stock of a growth company may not be a growth stock as such. So, when you say growth means a good stock which has a lot of potential, the earnings and the sales and everything of the particular company is maybe increasing at a rate more than the normal industrial growth as such. So, but not necessary that the stock of the particular company may be actually a growth stock as such. So, we will discuss further about in the following points. When you say growth companies, there are two approaches of talking about growth companies. The first one is that the company as such have been having a sales or earnings growth which is more than the normal industrial sales growth as so. That is one analysis, one point of view. And the second point of view is the when we talk about financial theorist which define a growth company as one with management opportunities that yield rates of return greater than the firm's required rate of return. So, what you discuss here is that essentially we have got a return from the company is called R, and then we have got expectation from the investor is called K, and K is also known as weighted average cost of capital, as popularly known as WACC. So, a growth company is that company where the R, the return on the company overall return is more than the cost of capital. So, financial theorists advocate this as the mechanism to find out the company is a growth company or not. If it is that necessarily obviously the company which has got R as more than K, so this company is going to actually attractive proposition to invest as such, but at the same time the particular company's stock may not be actually a growth stock, it may be different because of other reasons as such. Then we move on to the growth stocks as of how to define growth stocks. So, as we discussed, growth stocks are not necessarily shares in the growth companies, it can be something different. What we mean to say that there may not be company may not be a growth company, but the share of the company may be actually a growth share, or a stock of the company may be a growth share. Similarly, company may be a growth company, but the stock of the company may not be a growth stock as such. So, and when you say growth stock, that means the company's stock has a higher rate of return than other stocks similarly. So, in the market there are several stocks are listed and traded and their prices are there. So, this particular company is relatively better than the other companies, and that is why it is called a growth stock as such, not necessarily that the companies, this particular companies, its company itself is growth company. Then we move on to the next point where you talk about that the particular stock will be having a superior risk adjusted rate of return because the market undervaluation compared to other stocks. So, compared to other stocks, the particular company may be stock may be undervalued. So, this means opportunity to invest, but what happens subsequently when all the investors come to know about that. So, people again will go to invest in this company, this stock, and subsequently what will happen, the price of the particular stock will increase and it may not offer another supernormal or abnormal or a higher rate of return than the other stocks as such. So, that is one thing one has to keep in mind. For all the time the particular company may not remain as a growth stock, or once the investors or potential investors come to know about the good things about this company or the stock, essentially it will attract more investors, and then the price of the particular stock may increase and the advantage of being a growth stock may not last for a longer time. Then we go to different other classification of stocks as such. In the market we must look at those stocks like there is something called defensive companies and the stocks. When you say defensive companies, actually in this case the future earnings are more likely to withstand an economic downturn. So, what we mean here that if there is something going to happen in future like economic downturn is going to happen, these stocks are not going to these companies are not going to suffer like the economy and they will be suffering lesser than the economy as such. So, typically these company stocks, if the company stock is also defensive stock, in that case what will happen, you will find that the companies will have stocks will have a lower systematic risk or negative risk, negative systematic risk, which is represented by beta as per CAPM, and these companies will also have low business risk as well as quite likely low not excessive financial risk. Once the company have low business risk, it is a good proposition that they are not going to suffer because of any recession that is going to happen. At the same time, these companies may not be able to get the maximum advantage out of the booming condition or expansionist condition in the market. That is also another point one has to look at. So, they will be typically behaving contrary to the overall economy or overall industrial condition as such. Then we have next category of cyclical companies and stocks. When we say cyclical companies, it is more like they are the where the sales and the earnings are influenced by the aggregate economy. So, cyclical companies examples could be the auto industry, which is supposed to be a cyclical industry, and then cyclical stocks are those that will experience changes in the return greater than the changes in the overall market rate of return as such. What happens in this case, in the cyclical stocks case, if the market is going to up by certain percentage, the cyclical stocks return is going to more than that. Typically what will happen, cyclical stocks may have a beta of more than 1. So, obviously, it is a little more risky as such, because the moment beta is more than 1, if the market return is x percent, then the stocks return will be more than x percent. Unlike in our in the earlier class of companies as defensive stock, where we talk about low beta, that means beta will be less than 1 definitely and much lower than 1 itself. So, what will happen in that case, low beta means if the market rises by certain percentage, this will also rise a very lower percentage. At the same time, the market falls at a particular percentage, let us x, falls by x percent, then the stock will fall very negligible, because the beta itself is very low as such. Whereas, in case of cyclical stock, it is going to be other way around. The market is up by x percent, it will be more than x. That means, if the beta is let us say 1.2, the market goes up by 10% the return, then the stock will give expected to give 12% return. So, this is the cyclical companies, which is supposed to be little more riskier than other companies as such. Next, we have the category of speculative companies and stocks. In speculative companies, when you mention, these are the the company will have assets certain have very high risk, and but at the same time lot of potential can also be there. When you say very high risk, like technology development companies, the companies which are into development of new patents, technologies, copyrights, like that. In that case, it is not necessary, because companies will be investing a lot and developing few technologies out of that investment, and some of the technologies may not be successful also. 1 in 1,000 may be successful. So, but that successful product, the technology can be blockbuster for that matter. Certain R&D companies in the pharmaceutical sector also can come under this category. Then we have oil field is another example, where we have oil exploration. We may go for searching for oil for several places, but ultimately 1 in the 1,000 may actually hit. So, we may be successful. So, those are the examples where you got the very speculative companies as such. There may be 1 in a 1,000 chance that this particular effort of the particular company may be successful. Then we have next the speculative stocks is that where one can expect a very high probability of low return and very low probability of excess return. So, what will happen, this company's share price may be a very high at this point of time, the price on which the particular stock may be very high, and but when the downturn happens in the market, and the stock is going to suffer like anything as such. So, these are certain examples of speculative stocks, which is very high price, and this a huge fall is expected when there is a market crash or market is also going to decline. So, these stocks are going to decline like anything as such. Then we have the categories of investment called value investing versus the growth investing. When you say growth investment, growth stocks, we say growth stocks are those which have got certain expected earnings surprises, and it has got above average risk adjusted return. So, these are the companies, the stocks which are offering little more return than risk adjusted return, like that. So, for instance, when you say risk adjusted return, we can apply the CAPM framework. CAPM framework, the return could be like this: RF plus beta Rm minus Rf. So, this is the return which is expected, but a growth company can actually have a return much more than this. This is the RADR, risk adjusted return or risk adjusted return, and but the RADR, but actual return is expected to be more than risk adjusted return as such. Similarly, and in this case this company stocks are going to be undervalued, and then value stocks are those stocks which appear to be undervalued for reasons besides earning growth potential. They may be undervalued depending on the present company, present condition compared to other companies, they may be undervalued. So, that is a lot of potential there, and value stocks are likely to have something like a low P ratio or low price to book value ratio also. So, these are the value stocks. So, there is a lot of potential. The high low P ratio means there is a chance. So, low P ratio, let us say the average P ratio of a particular industry, let us say 12, but the companies, this particular example company maybe the P ratio could be 8. That means there is a potential that the price will move up to 12 times of the earnings. So, that is a lot of potential there, that is a type of value stock. So, the price to book value is nothing but market price by the book value of the equity. Where you talk about, let us say price to book value is, let us say 1.2, but the particular company that you are looking at may be having a 1.0. So, there is a potential that price to book value of this particular company stock may go up from 1.0 to 1.2. This is the average which is observed in this particular industries. So, these are the attributes where price earning ratio and price to book value ratio of a particular value stock is actually lower. There is a lot of value proposition there, and investors can maximize the have a gain over a particular period of time. At the same time, all these growth stocks and value stocks are maybe a matter of time also, because of certain reasons all these attractiveness of particular stocks may vanish, or since the particular companies are actually attractive in nature, more investors may come. In that case, what will happen, the price of the particular stock may go up, and all these fine points of the company as attractiveness may actually vanish over a period of time. So, this is not going to be there permanently, they are only a particular valid at a particular point of time, for a particular duration of time for that matter. Next we move on, as we discuss here, we can see that the value stocks usually have a low P ratio or PV ratio. Then next thing that we move on is that linking what you discussed in earlier, economic analysis, industry analysis, and also certain structural links as a part of company analysis. We did discuss about economic analysis independently, we talked about industry analysis independently, but now once you look at a company, we should also go back and find out what is the economic condition, what is the industry in this, what the company belongs to, and in the industry where the company actually stands, as what the competitiveness of a particular company in that particular industry, that also has to be looked at. In this economic industry analysis, what we talk about that, as we discuss company analysis, the final step in the top down approach, and there are certain macroeconomic analysis which says that particular industries may be attractive. As we discussed in industry analysis earlier, we say that depending on the circumstances, the analyst may go for like industry rotation. So, which are switching from one is another industry because of the macroeconomic condition, one particular industry may be now attractive than the earlier time. So, they may one may switch from one industry to another industry, that has to be looked at. Then we also look at the different firms in the selected industries, and then we talk about the stocks which have got intrinsic value, and their intrinsic value will focus on, and the intrinsic value is actually a function of like the growth in the earning, growth in the revenue, growth in the profit for that matter, all attributes, growth in assets, all those things, and also the particular risk involved in investing in that particular stock, that also has to be looked at. These are the two things which has to be looked at, and these two things can depend upon different factors of economy, the factors in the industry, and the company itself, company's management, company strategy, company choices that the company enter in different segments. All those things are going to affect the growth of a particular company, as well as the risk involved in the particular company, and obviously the stock of the particular company also. Then we move on to the different economic and industry influences. In this we talk about that if the particular trends are favorable for an industry, the company analysis should focus on farms, that industries that are positioned to benefit from the economic trend. So, the economic trend is actually going to be beneficial, the industry is going to look up for whatever reason, then one has to look at which are the companies who are going to take advantage of that particular. It is not necessary that if the particular industry is going to do good, all the companies are going to take the advantage of that. For instance, if for some reason there is a rapid stride in technology in that particular industrial sector and industry for that matter, then it is not necessary that all the companies in that particular industry may take advantage of that, because to go to for that particular technology, the company should have the financial potential and the cash flow, enough cash reserve has to be there, or at least to potential to get the money should also be there, capability to raise finance also should be there. So, mere advancement technology in particular industry, which may be a good thing for the industry, does not mean that the particular company in that particular industry is going to benefit out of that. The company should have the adequate capability to access that particular technology as such. So, one has to look at which are the companies which are positioned to benefit from the very good economic trend. Economic trend may look at expansion, but the company may not have the ability to expand, because company may not have adequate fixed assets to expand. For the adequate fixed asset, they may have to again raise finances and go for acquisition of fixed assets and set up that plant and all those things, and that may actually take lot of time, they may lag involved, lead and lag may be involved in that. So, by the time the company is ready to put up the expanded capacity, the opportunity may actually be lost by that time. So, that is another thing one has to look at. Then obviously, one has to look at the firms with sales or earnings particularly sensitive to macroeconomic variables should also be considered. It is not necessary that only industry have to look at. There are certain companies sales or earnings may be actually affected by the overall macroeconomic variables. So, if there could be, one can find out which is the companies in the particular whatever sector for that matter, where it is going to be affected by the economy. So, and how far is going to be affected, how what is the relations between the economic changes and the company's expected performance, that also looked at. For instance, in a cyclical company, cyclical industry or in the company for that matter, it is likely that when the industry is actually going up, overall economic conditions is better, these companies are going to benefit out of that. So, if the company is already having a good operating leverage, which you talk about the presence of fixed cost in the cost structure, then that means they have a high amount of fixed cost to in the total cost structure as such. These companies are going to benefit a lot, because with more and more output, their fixed cost is going to be spread and the cost per unit is going to actually be lower, and the contribution margin is going to be higher for those companies. So, they are going to benefit in case of expansion scenario, and the cyclical companies, or at least those companies which have got high operating leverage as such. Obviously, in a contraction phase these companies also can suffer, but as an analyst one has to look at which is company which is able to take the advantage of this particular good condition in the industry or good condition in the economy as such. Then we also have other things. So, what happens in this recently, as we discussed, has to be familiar with the cash flow and the risk of the firms. As you discuss how the cash flow is going to change, going to better or not, because the economic condition is good or not. Then we have other factors called structural influences. When you talk about structural influences, we are talking about like social trends may be there may be a change in the fashion, there may be a change in desire, there may be change in consumer preference, the consumer demands may be different as such. Then the change in technology can also be there, change in political condition can be there, change in economic conditions can be there. All those things are also going to affect the structure of the industry, and because of that particular products may not be now acceptable, or new products may be required to meet the customers requirements. So, that also has to be looked at, and which company is particularly able to take the advantage of these particular changes and introduce new products, or the products have become old fashioned, then should exit from that particular products. All those things also have to looked at as a structural influences. Then we have next is we will have certain companies in industry life cycle, and that we have changes in technology which followers may imitate and benefit from. So, what happens in the when the new products are introduced, in the initial stages the whatever companies have invested, they may have the ability to go for new products there, but there could be a lot of mistakes by them. So, when they come to the maturity stage or the next stage of growth, other companies may follow, because they look at this particular product is a more attractive proposition. So, it attracts more companies to invest in that particular sector. So, these players who have entered the market later, they will take the lessons already learned by the leaders as such, and in fact what happens is subsequently the second companies who have entered later may actually outsmart the companies which have entered the segment earlier as such, because they do not have the learning curve problem, but earlier the other companies had learning curve problem as such. So, that is one. So, in the early stage this particular phenomena may be there. Similarly, we can have certain political condition which changes, the regulatory condition which deregulation can happen. So, new company, new sectors may opened up, and we can see that the banking sector what was there earlier. Now, if you look at the banking sector now in India, it is quite different. So, we have new products in the banking sector has come. Earlier whatever products savings or loan products were there given by the banks, we used to be happy with that, we do not have much choice. But now with deregulation the banking and financial sector, we have seen that new products have come up with the banking and financial sector as such. That is one such things which, so it depends upon which particular company is able to take advantage of these changes, social changes or technological changes, or the cultural change that is happening, or the regulatory change that is happening, which particular companies take advantage. There may be certain negative changes also in this like political or regulatory environment. So, which company is going to take its this same thing in its stride and lose the least as so, that also has to be looked at, because there is a unfavorable changes, obviously the all the companies in the particular industry are going to be affected. So, we have to see which particular countries particular company is actually going to least affected by these unfavorable conditions. Next, coming to the different types of analysis that we have, as you said in the beginning, company analysis we will discuss. In this case, we will have strategy analysis, we will also discuss something called financial report analysis. And so, financial analysis will be covered in the subsequent session. Coming to the first part of analysis, strategy analysis, we will talk about here what do we mean by a strategy, and what are different organization label, and what are different strategy decision that is different level organization have. We have already discussed the Porter's 5 forces model in the industry analysis. Now, we are going to talk about that again, see that and what is the effect of that particular model in the context of company analysis. Then we will talk about in this case PEST, that is political, economic, social and technological change analysis. Then we are going to discuss about SWOT analysis. So, these are the methods, the things are discussed as a part of strategy analysis in which is a part of the company analysis. Coming to the definition of strategy, what do you mean by strategy? Strategy is something is a plan of action designed to achieve a particular goal, and this is from a military origin word which is derived from the Greek word like strategos, which is actually something like transgeneral. So, what you say that there are certain things to be achieved by somebody or some company or some group of people for that matter, and what is the state of action the company is going to take, or the group is going to take, or the individual is going to take, that is called the strategy as such. So, it is not necessary the strategy is for the company's point of view, any individual can also have a strategy, an investor can have a strategy, a student can also have a strategy to achieve the best result in the examination. So, a particular set of action one has to take and then see what is being done as such. So, there is a definite strategy. Then why one should go for strategy as such? There are certain studies which say several companies actually fail, they go for premature death, means we are expecting the company to last for longer time, but subsequently what we find is that the company do not last for longer time and they may die an early death as such. So, why this could happening, that the companies may not have any strategic intent, they may not have planned what is that should be done. The company has a very passive management. Passive management means is not taking cognizance of what is happening in the market, and they are not entering new market, they are not exiting from the old products for that matter, which has got old fashion, they are have no consumer attraction for that matter. So, they are not actually typically cognizant of what is happening in the particular environment, external or internal. So, that could be another reason. Then we have certain new opportunities the companies are not exploring, and similarly there are certain changes which is happening in the immediate surrounding, but the companies are not able to take advantage of that or they take the cognizance of that as well. So, this could be the things why the companies actually fail. In fact, there are certain things like any company for that matter, in its present form will obviously die in a limited number of years and number of period of time as such, because the companies exist primarily to produce and sell, and they should be producing and selling things which are relevant for the market. So, a relevance of the market particular product will not last for longer time, it will last for a limited period of time. So, that is the lesson that before the particular product that is introduced a particular company it becomes irrelevant, does not attract the customers or consumers, the company has to go for new products. So, in the present format of the organization and the product market for that matter, the company will last a limited number of years. So, it is a challenge, the company has to come with new products, they have to be different also, and they have to produce maybe same thing at a lower cost, whatever that may be, that should be something attractive for this particular company's product to be sold to the potential customers. Only that is there, the company is going to close. We can see if you look at the corporate history of the world, we have the first corporate form of organization like East India Company, which was used by the British for that matter. So, this is hardly 200-300 years old. So, we do not have any company older than that, and we see because of different things happening in the market, maybe because of mergers, acquisition, out of that we find several companies cease to exist, several companies get acquired. So, they lose their relevance, they are not no more the same name, same brand, all those things are not there. So, they to be to be there in the market, the company has to continuously come with new products, innovation has to be there, R&D efforts have to be there, growth has to be there, and there now the entire economy is free now. So, anybody can from any world, any part of the world can come and pose a competition or threat for the existing company in that particular sector, so or that particular country. So, one has to be on the toes to be performing and perform to the satisfaction of the customers and the overall stakeholders. So, next we talk about the different strategic levels of a particular organization. What we talk about here is we have the first level is the corporate overall business company corporate strategy, where you talk about that discuss the management decision will be what is the where the company should actually put its resources, which particular sectors it should be into, and when should you enter a new market, and should you exit from the existing market products that we already have, because the products are not no more attractive for that matter, they do not no more the growth products, they are maybe they are in a decline stage. So, those decisions have to taken at a very corporate level, maybe the board of directors they will be deciding about that. Then having decided that there are different types of products the company should enter, then we go for the strategic business units. So, one particular company may have multiple SBUs, and each SBUs will talk about what is the style of growth this company, how to achieve the best growth in that particular business segment, how are you going to face the competition from the competitors in that particular segment. Those are the decisions which will be taken in case SBU, so that the SBU has got the best possible revenue and best possible profit derived out of that, and also they give the best return to the company as a whole. Then the next level is our operating strategy, where we talk about what are the different actions, could be financial management action, could be marketing management action, operational management action, so that the SBUs are actually successful. And all those decisions that we are talking about, whether it is corporate level or business level or at operational level, all those decisions are going to affect the cash flow of a particular company. That is why it is very much important from the analyst point of view, so that one should analyze and find a valuation of the company, keeping all those things in mind. Next we go to the famous model that we discussed earlier, that is the Porter's 5% model we discussed in our industry analysis. And when you talk about Porter 5%, there are 5 different things that is there, 5 different forces that affect the industry performance. It also affects the company's performance indirectly. The first thing that we talk about in this is current rivalry, there is a rivalry among the companies in that particular sector, how much how fierce is the competition, or they are in hand in glove with each other, and they are actually having collusion in the market for that matter. So, how fierce means maybe different companies are coming with different products, they are competing on the cost front, or they are able to produce at the least cost, so that they are passing on the benefit to the customers. So, the price is the factor there to decide whether the customer should go for this company or the other company, or the product, it is a fierce advertisement is there, so that there is a the mind space of the customers are acquired, and so the company, the particular customer goes for this particular product because of the advertisement effect. So, a lot of advertisements could be seen in a particular sector. Then the next category is the next point of Michael Porter's 5% model is what is the threat of new entrants. So, is this particular industry open to new players, what is the threat from their side. So, that is also another to look at. So, if the threat is very high, the company has to look at possible potential of joint venture alliances, so that with the new players, or companies should have the capacity to expand, so that it can thwart the competition from the new players. Then we have another thing called the what is the potential substitutes for the products being sold. We can see in as we discussed in this analysis that in the furniture space we have got the wooden furniture being replaced with the fiber based furniture these days. So, this is a substitute which has come, it has the fiber based furniture itself has become a new industry for that matter. Then what is the threat from the suppliers, or the bargaining power of suppliers is there is very high, because the supplier bargaining power is high, then it is going to, they may actually come to our company's product space, and they may actually do the industry, do the same thing as what we do. And if there is a limited number of suppliers, also another serious problem for the existing company, that also has to be looked at. Then what is the bargaining power of the buyers. If the buyer has got more bargaining power than the, as a seller we have to sell at the price dictated by them rather than by us. So, these are the things that one has to look at, and for finding out the position of the particular company in the particular context as such. So, what is the lesson that we learn from this model is that the what are the takeaways that you have from the Porter's analysis. The Porter analysis will help us in finding out the attractiveness of the industry. So, which particular industry is more attractive in terms of margin. So, the company which is going to have more margin should have these 5 forces I talked about. It should have the least threat from the supplier, least threat from the buyers, the bargaining for the buyer and supplier should be less, and threat for the new entrants should be high, and so rivalry should not be as much. So, these are the things which will be affecting favorably a particular company in a particular industry. So, and that is going to drive the profit margin to be higher as such. Second thing is that this also helps us a particular company to exit from a particular product or enter a new product, depending upon what type of supplier you are or what type of buyer you are, you can go into the supplier space or your buyer space for that matter. That is one thing also one company can look at. So, what happens in this case, one does an industry analysis of its own and also does an industry analysis of the supplier, industry analysis of the customers or the buyers as such. So, depending on the threat for the new entrants in those respective sectors, suppliers industry or the buyers industry, the present industry can also enter that particular market. Similarly, the threat for the particular products in that particular industry is very high from other people. So, it is maybe right time for the company to exit from the particular segment. So, these are the things one has to look at. Then also it also talk about a very systematic approach of the market structure, who are the players, what is the competitive situation, the particular company is more competitive or not, industry itself is competitive to operate or not. These are things also which will be disclosed or by the Porter's 5 analysis. Then one has to also look at the another takeaway from this particular model is that it helps us to understand the strategy of the company to reduce the power of competitive forces. So, if there are there are few more players in the market, so what should be the company doing to reduce their power. So, these are the brief things that takeaways from the Porter's 5% model. One has to, as an analyst, one has to look at these particular things and find out whether this particular company in its portfolio or analysis has got all those advantages or not. Then we move on to the same farm competitive strategy as a part. There could be looking at the scenario in the industry, looking at the scenario in the Porter's 5% model, the companies may choose two different strategies. One is a defensive strategy, another is a offensive strategy. When you say defensive strategy, it is something is going to happen in the market, the company take a position and accordingly fight that particular threat or something like that. The company may go for expansion because there is a good demand for that matter, or there is a new player which has come, there is a threat, so the company goes for an expansion. Whereas the offensive strategy is something the company itself triggers a thing in the market, so that the other players in the market are caught off guard. So, they do now there it is for them to react what we should do to counter the competitor. Suddenly the company may go for reduction in the price, because the company may realize that this has got a lot of scope of producing the items, the products, and the cost of production may be there higher, but the small margin from selling the product and huge volume can actually take care of the overall profit required. So, the company may go for reducing the price, and that may be something which the other competitors may just not be expecting in the market as such. So, that is one thing which offensive strategy. The company may go for a huge advertisement exercise, the company may go for a new technology tie up another company for that matter, the company may go for a joint venture, the company may announce a sudden entry in another market. All those things the company does on its own as a posing a threat to the competitors in the market as well. So, there could be a defensive strategy which you would take the help when the as a reaction. Offensive strategy is something when you do that, so that other competitors react to that. So, they will be in a defensive position as such. Then another type of strategy that is the Porter has suggested, which is called the low cost strategy and the differential strategy. When you say low cost strategy, the companies in that particular sector or that industry, that whatever companies are there, company may have multiple products. In that one of the products, some of the products, the company will like to have the least cost producer. We have seen in India, for that matter, in the airlines industry earlier, the Air Deccan was the first company to come, which is offering the lowest fare as such. And what they did, actually they did not have any frills and all those things in the for the passengers. They had the limited facility for the passengers, but they were to provide the air travel from one place to another place in the country at a very lower price than the existing players what they used to offer as such. This is another strategy the company followed. We now see all the airlines have got both high cost or high price tickets airlines, as well as the low cost routes for that matter, low cost tickets for that matter. So, different airlines are there, different services are there for that matter. Like in India we have Jet Airways, which has got Jet Light, which is nothing but this Air Sahara, which was acquired by them, which has been named as Jet Light first. So, Jet Light is something like economic service compared to other part of the particular airways as well. So, similarly Air Deccan, which is subsequently taken over by Kingfisher Airlines, and so Kingfisher had the luxury part of that, which has got all the benefits given to the passenger, amenities are more there, whereas the Kingfisher Red, which was earlier known as Air Deccan, which has the limited facilities for the passengers as such. So, that is another strategy as such. Then another strategy that we talked about, the differential strategy. Differential strategy means the company is producing certain things and there is certain products which is something different than the existing competitors products as such. So, the differentiation can come from different things. The company has got superior technology, that is why it is able to produce at a lower price, lower cost, so perhaps less. The company has got certain products which has got different features, which is not there with any other product of other competitors. The company has gone with a very big advertisement, it has acquired the mind space of the customers, it has got a lot of attraction for that matter, that could be another thing. Then that is just different things where the company has got different things. So, the customers come to this particular product for certain different attributes as such, there is something extra, something different than the existing product. So, there could be low cost strategy or could be a differentiation strategy, and but at the end of the day no company follows a single strategy, whether it is a offensive or defensive. In certain cases we may go for offensive strategy, certain cases we may go for defensive strategy, because companies do not sell a single product to follow one strategy as such. Companies have a product portfolio in a particular segment, in a particular SBU for that matter. Look at an FMCG, we have got different products being sold by one fast moving consumer goods company or a consumer durables company, which have different things to be sold. So, for different items to be sold, the company may adopt, in one segment they may adopt a defensive strategy, another segment they may adopt a competitive offensive strategy. Similarly, in some products they may have a low cost strategy, in some products they may have a product differentiation. Another strategy that the companies also follow is called the niche strategy. Niche strategy means the company focus only on a particular segment of the clients. They do not look at all the entire customer base, entire client base. Only few people they look at, few customers they look at, but they price a very high at a very high rate to these customers in the niche segment as such, and they know there will be very limited players, limited customers for the product in that segment, but they are certainly going to there, but they are going to price a very high charge a very high price to the player, to those customers. So, this is another strategy also companies may adopt. So, as you discussed, the companies may follow different strategies depending on the product portfolio of the company for that matter. Next, we move on to the second one of the tools of analysis called SWOT analysis. When you say SWOT analysis, nothing but strength, weakness, opportunity and threat. So, one has to look at the companies or firms strength, weaknesses, opportunities and threat, and in fact the strengths and weaknesses come out of the internal analysis of the company. So, look at the what is the existing system of the company, where are they having good opportunities, what are the weaknesses for that matter, and so internal analysis will talk about what are the strengths of the particular company, and similarly look at the next one, that your opportunities or threat, that depends upon the external analysis. When you say external analysis means the outside condition is going to create more opportunities or are actually going to pose a threat for the organization for that matter. Now, coming to the strengths of the company, the strengths could be like we can have good capabilities, the company may have good capabilities of producing good products, the company have good products for that matter, the company may have good technologies, the company may have good R&D efforts, the company may have good human resources. For instance, the R&D companies they can expect very good demand from the client, from the investors, in terms of they have got good number of scientists, good amount of knowledge power they have, because particular knowledge based industries will always go for good human resources, the good technical skill they should go for, whereas companies in manufacturing sector and steel or iron, steel, automobile, they will always look at the capacity as a strength of the particular company. So, how much what is the production base they have, that could be the thing, whereas a knowledge based company is something else. Like a banking company, strength is having how much capital they have, how much adequate capital they have, that could be the strength of the company. So, different things are there. Similarly, technology is something which is there, which the new technologies to be there for the companies, which is always going to be there for any company in any sector for that matter. It is not necessary that technology is only applicable for a particular industry. Technology is something applicable for anyone, because certain companies take the advantage of technologies to produce the things at a lower cost or the least time possible. The least transaction cost, like banking companies should take the advantage of technology available, so that they can provide the service to the customers, the clients or the accounts at the least time possible, and the least cost is also involved, and that is one. Similarly, there could be also certain weaknesses of the company. So, the weakness could be that product has become obsolete, technology has become obsolete, key management power may not be there, key manpower may not be there. So, the point is not that the company is having weaknesses, that means the company should close down. The best part is that whether this company is able to trace this weakness and take the corrective measures or not. So, the companies feel that the technology itself is not good, what technology they have is not competitive in nature. It is high time that the company can go for a technology type with another player, and they may offer an ownership in the company and they go for technological tie up, or they may go for a joint venture for that matter, and so that they can have the best technology available from the new player and they can still continue to exist as well. So, the company has to look at that thing, the agility has to be there, that yes, there is certain threats, there are certain weaknesses of this company and the weaknesses have to be overcome. So, that is one. So, joint venture, alliances, all those things can take care of these weaknesses for that matter. Then we move on to the opportunities that the companies have, that What types of opportunities and threats? The opportunities and threats come out of the external analysis. Looking at the external analysis, the company can find out what the opportunities are there. Opportunities could be there in case of like company can identify new products, the company can go for new sectors, the company can go for new geography for that matter, new economy, the company can go and extend their market, and company can take the advantage of the changing lifestyle. So, we can see the economic framework of the particular companies and industry is changing, and the company can go for the opportunities available, the technology is changing. So, new things should come up. So, take the advantage of technology, the fashion is changing, the life condition of the lifestyle things are changing. So, go for new, like particular fashion industry, one has to obviously look at the lifestyle changes of the customers as such, otherwise age profile, demographic profile may be changing. So, take the advantage of that and introduce new products in the market and get rid of the old products what the company has. Then one can have the threats also. When you say threats, we talk about the threats could be political threat could be legislative threat, there could be environmental threat, there could be technology threat, there could be threats from the partners, the joint venture alliances, there could be threat from the buyers, that threat could also be there from the suppliers, and there could be threat also from the key staff, the company may leave the organizations. So, all those things are there, the threats could be there, but the best thing will be how the companies take the advantage, take care of these threats and go for a counter action, so that the threats are actually minimized. So, these are the things one has to look at in SWOT analysis. The next thing that we have is the PST analysis, and in the, that is called the political legal changes, then you have the economic changes, social changes and technological changes. So, in this what you say here is that when the political legal changes, we look at the change in the government and policy or law. The law could be like the environmental law, the industrial law, the employment law, or safety law, all those things are there which are going to affect the company's conditions. So, these are the things we want to look at, and how the companies take the corrective position, so that they are not on the wrong side of the law as such. Next thing that you have the economic changes, where you talk about the rising level of living standards, the change in the interest rate, the inflation change, the government's policy change, the fiscal policy changes. So, how the companies get the advantage of that, the changes, and withstand the prevalence from the changes that has happened. If the inflationary condition is there, that can affect the cost of the particular raw material input of the company. So, how the company is going to hedge that, how did the system the company has to take the hedge against the price rise. So, all those things have to be looked at in case of economic changes. Social changes is something where the demographic profile, the people like more of like both the spouses working, one of the change that we see there. So, that definitely there is a lot of consumer surplus, consumer has more disposable income to spend. So, new things can be developed and sold to the this particular clientele base. Then the ultimate thing that you have got the technological changes. So, there could be new invention, there could be new ideas, new processes, all those things the company has to take advantage and accordingly come with new products and be in the market as such. So, these are the things that we discuss, and the overall that we talked about is that in a strategy analysis, we have got internal environment where you look at the review of resources. Resources could be tangible like fixed assets, machine, capabilities. It would be intangible, which are nothing but they are not reported in the balance sheet, but they are always there. Intangible technology also part of the balance sheet, or in like patents and copyrights, or intangibles could be the brain power or the human resource of the company. Then one has to look at the capabilities also. What are the knowledge based capacities, what are the R&D capabilities, what are the type of customer services support. There may be certain companies which are good for the after sales service. So, the customers go to that particular company's product because the company has got a good customer service. The company may have the good global operations, or the company can have other core competencies where the firm is functioning very well. So, this is what we discuss in this part of the company analysis. Essentially, we talked about the strategy analysis there by taking help of Porter's 5 forces model, SWOT analysis and PEST analysis. In the subsequent session on company analysis, we will discuss about the what are the different authors or researchers, authors researchers say how to choose a company based on their strategy, and also talk about how do we read a financial report and what are different finance analysis tools we are going to use, in addition to the finance analysis that we have discussed in the earlier sessions also. Thank you.